A very, very warm welcome. A very to each one of you. A very good evening, and hope everyone is taking good care of their health. So the two chapters which we are going to do today are your chapter 9 and chapter 10 of the module. Chapter 9, which is called as income of other person included in assessee's total income, which we commonly called as clubbing, and then after the break we'll be doing chapter 10 again. The same drill, please be participative, ask as many questions you want, and please answer the questions which I ask. So I understand up till now you have done all heads of income. So now once all heads of income are understood, we move to your clubbing provisions. Now what are clubbing provisions and why? I'll share. What are clubbing provisions? So why clubbing provisions are there? Now, we all know that there are various income tax rates across the categories of person, and especially when we talk about slab rates, which is more the income, more the tax rate, right? So the person who are having higher rate of income tend to evade tax by them, but belong to some other person, commonly their minor child or their spouse, etc. Okay, so to avoid where a person evades tax by diverting his income, clubbing provisions were introduced. Obviously loopholes still exist, but till quite extent they have covered the cases where even if the income is not received by you, it is received by someone else, but it would be deemed to be your income and it will be added in your income. Now when it is added in your income, that will mean that it will not be chargeable in the hands of the other person. Same income cannot be taxed in the hands of two persons. So let's begin. Now, up till section 58, 59, you have done your other sources. Now we start with clubbing, and clubbing is covered from section 60 to section 65. So first provision of clubbing is covered under section 60, which talks about transfer of income without transfer of asset. Transfer of income without transfer of asset. So what do you mean? As simple as it can be said. Very common example, I have a house property in my name, but I write in the rent agreement that instead of giving me the rent, this rent should go to my mother's account. So now this is what has happened. I have not transferred the asset to my mother, right? But the income which is received by my mother, because I have transferred the income without transferring the asset. So in that case, the rental income would be taxed or would be clubbed in my hand as per the provisions of section 60. So if any person transfer the income from any asset without transferring the asset, such income would be included in the income of the transferor, which was me in my example. It is immaterial if the transfer is revocable or irrevocable. What is revocable and irrevocable? As per income tax, yes, we'll study in the next slide. But revocable and irrevocable means something which is being capable of cancel or something which is being capable of annulment. That is your revocable or irrevocable transfer. It is immaterial whether the transfer was made before the commencement of the act. So examples, Mr. X through a duly registered document transfers the rent arising from a godown to his son without transferring the godown. So as per the provisions of this section, such rental income shall be clubbed in the hands of Mr. X. Clear? So first section done, transfer of income without transfer of asset. Yes, it is this simple. Next is our section 61, which covers income arising from revocable transfer. Income arising from revocable transfer. Now, what is this revocable transfer? Now, I told you revocable transfer means a transfer which can be cancelled or annulled, but income tax has clearly defined revocable transfer, which is being defined under section 62. So, first, to understand this clubbing provision, let's see what is revocable transfer. Now, in layman term, if I have to explain you, I transfer some, as in say Mr. A transfers something to Mr. B with a condition that he will have, Mr. A can have the right over such asset or over income which has been transferred. So let's say he has transferred a house property. Mr. A has transferred a house property to Mr. B. With or without consideration does not matter. Okay, but it has a condition that Mr. A, such transfer has a condition, Mr. A can at any time bring the asset back, or Mr. A at any time can have the income from such asset, or Mr. A at any time can have the right on such asset or on the income of such asset. So basically, whenever the transfer has a right to revoke it back to himself or has a right to exercise on such asset, that is a revocable transfer. That means even if you have transferred it, but you have still maintained some authority or the power on that asset or on the income deriving from that asset, that would be a revocable transfer. Now, what will happen in case of revocable transfer? Whatever income is arising from this house property, which is a case of revocable transfer, would be, instead of Mr. B, who is the beneficiary, would be taxed in the hands of transferor, which is Mr. A. Because this person did so only because that he can just in the names or just in the paper can transfer the property, but at the same time can have the or enjoy the full right over it. So it is not a transfer, it's a revocable transfer, and hence the income would be taxed in the hands of transferor by clubbing provisions under section 61. Did I write section 62? The definitions in under section 63. Sorry. Okay. So what is revocable transfer? Now, as per section 63, the transfer is deemed to be revocable. When it would be deemed to be revocable, this is clearly given in section 63. When any provision for the retransfer, directly or indirectly, of the whole or any part of the income or asset is there to the transferor. So Mr. A has any provision in that transfer that this asset would be retransferred or the income from such asset would be retransferred, then it is a revocable transfer. Second, a transfer is deemed to be revocable if it gives in any way to the transferor a right to resume power directly or indirectly over the whole or any part of the income of the asset. So whenever such thing happens, whenever there's a condition that the right would be enjoyed or the asset would come back to the transferor, this is a revocable transfer. Clear? Yes or no? Is it clear? Now, interesting question comes here is, first thing is that suppose a question comes, if only part of the asset is revocable or the only part of the asset is where the transferor will retain the right, whether the whole income would be clubbed or only the part of the income would be clubbed. Whether the whole income from that asset would be clubbed or only part of it would be clubbed. So the answer to that is the whole income would be clubbed. Even if we write here that over the whole or any part of the income or asset, there is a right to resume power, then also the whole income of the asset would be clubbed. Number two, revocation, clubbing provisions will happen from the date when the right to revoke arises. Clubbing provisions will happen from the day when the right to revoke arises. Now, what do you mean by right to revoke arises? Suppose I have a deed with you today, but in that deed, I write that my power to revoke such transfer will happen after 10 years, will happen after 10 years. So after 10 years, the clubbing provisions will apply. Clear? But yes, there are certain exceptions where even if it is a revocable transfer, what did I say? Even if it is a revocable transfer, clubbing will not happen. Clubbing will not happen. What are the exceptions? Exception one is that you have made a revocable transfer, but it is not revocable during the lifetime of the beneficiary. So Mr. A transferred the house property to Mr. B, but this would be revoked only when Mr. B dies. Only when Mr. B dies. Mr. A has a revocable transfer done, but the revocation will incur only when Mr. B dies. So Mr. B is the beneficiary. The revocation will incur only when Mr. B dies. So in that case, your income would not be clubbed because revocation is happening after the death of the beneficiary. Number one. Number two, if such revocable transfer has been done before the Income Tax Act, 1961, and it was not revocable for a period of more than 6 years, then also even if it is a revocable transfer, the clubbing provisions will not apply. So for you at this stage is only one exception, which is operative, which is a transfer not revocable during the lifetime of beneficiary. Another exception was for the transfer which happened before the Income Tax Act and was not revocable for a period of 6 years. But this exception will also not be good if at any time the assessee directly or indirectly derives any benefit from the asset, derive any benefit from the income of such asset. Then the moment he derives benefit, the moment he reassumes the power, the income would start be getting clubbed. The income will start getting clubbed. So these are the two. We did section 60, which covers transfer of income without transfer of asset. Then we covered income arising from revocable transfer of assets. Any doubt or anyone needs any example? You can go through the exceptions. Section 60 covers transfer of income without transfer of assets. Section 61 covers income to be clubbed for revocable transfer. Section 62 covers its exception, and Section 63 covers the definition of revocable transfer. So now we move ahead to some types of clubbing provisions which are only applicable in case of individual assessee. It will not be applicable in case of persons other than individuals, but it would be only applicable in case of individual assessees. Income, where it will be clubbing provisions attracted for spouse income, for son's wife income, for minor income. These are the three categories: spouse, son's wife, and minor. Except these three, no other income would be clubbed in the individual. Then there is HUF, that where HUF income would be clubbed. So these are the 4 cases where clubbing provisions would be attracted. So now let's do each one by one. So first we cover the cases where spouse income would be clubbed. Where spouse income would be clubbed. The spouse income would be clubbed in 3 scenarios. One is your case of remuneration, where remuneration is clubbed of the spouse. Another is your case of transfer of asset for inadequate consideration. And last is asset transferred for indirect benefit of the spouse. You have transferred the asset to someone else, but the spouse will get the benefit. So first we see where the remuneration of the spouse would be clubbed. Okay. Now this is section 64 subsection 1 clause 2. Now simply this section says okay, one question before I go ahead. Ma'am, clubbing provision starts when revocation power begins. So during that period, if the assessee receives any income, will clubbing arise? Obviously, if the transferor is receiving any income, that means revocation has happened, because revocation, the definition does not say only revocation of the asset, but also the revocation of income. When he's reassuming or that income is getting retransferred to him, or he's having the right on that income, that means it has become a revocable transfer from that date, and hence the clubbing provisions would apply. Good question. Okay. Coming back to this. So I was saying about spouse. Spouse ka 3 types of income gets clubbed. First is your remuneration. Now remuneration ka there is very simple thing. If a spouse is getting a remuneration from an entity where the assessee, where the individual assessee has substantial interest, then that remuneration would be clubbed with individual assessee. Ma'am, can you please elaborate? Yes. So let's take an example. Mr. X is a partner of a firm called XYZ, each having 33%, 33.33% shareholding. Okay. Now XYZ firm is giving Mrs. X some remuneration. Remuneration can be salary, bonus, commission, any fees or anything, okay? In cash or in kind, is giving Mrs. X a remuneration. Then, as per the provisions of section 64, subsection 1, clause 2, this remuneration which is paid to Mrs. X would be clubbed in the hands of Mr. X. So I said that where the spouse is receiving a remuneration from an entity where the individual has substantial interest. I'll come to what is substantial interest. Then such remuneration would be clubbed in the hands of the individual assessee. Now, first question would pop in your mind that what is substantial interest? So substantial interest is when the salary is paid from the company. When the concern we're talking about is a company, then the individual or his relative together has more than 20% or more than that of the shareholding. And if we're talking about concern other than company, like a partnership firm giving the partnership firm giving the salary to the spouse, then in that case, substantial interest would be when you have 20% or more of the sharing profit rights. Okay, so when we talk about company, we talk about voting power. When we talk about other than company, we talk about sharing profits. Okay, so whenever such things arises, clubbing provision will arise. Now, second question which would come in mind is, or exception is, that clubbing will not apply if Mrs. X is qualified enough to earn such remuneration from such firm. That means she is doing such job or has such adequate skills. And by qualification, I do not necessarily mean having a degree. By qualification, we can have a sense of learning, a sense of skill set for performing that job. And for that, if she's getting paid, then clubbing provisions will not apply. Now, second question, you will say, ma'am, if both of them have substantial interest and both are drawing salary or remuneration, then what will happen? Then clubbing provisions will apply in case of that assessee who has income higher than the other without including this remuneration income. So now back to the theory part. All income which arises directly or indirectly to the spouse by way of salary, commission, fees, or any other form of remuneration in cash or kind from a concern in which individual has a substantial interest shall be clubbed with total income of individual, where both husband and wife have substantial interest in a concern and both are in receipt of income by way of salary, etc. Such income will be clubbed in the hands of spouse whose total income, excluding this remuneration, is higher. And once such things happen, it will continue to be clubbed in the succeeding years unless AO thinks that it is necessary not to do so. Income shall not be clubbed and shall be assessed in the hands of spouse if spouse is possessed with such technical or professional qualification and such income is solely attributable to the application of his or her knowledge and experience. So now let us take one small example. Mr. Arun holds shares carrying 55% voting power in MNO Limited. Mrs. Anamika, wife of Mr. Arun, is working as a computer software programmer in MNO Limited at a salary of 35,000 per month. She is, however, not qualified for the job. The other income of Mr. Arun and Mrs. Anamika are 730 and 420 respectively. Compute the gross total income of Mr. Arun and Mrs. Anamika for the assessment year 21-22. So in whose hand the clubbing provisions will apply? Mr. Arun. Why? Because Mrs. Anamika is receiving salary without qualification from a concern in which the individual has a substantial interest. And when I say individual has a substantial interest, means that he has some sense of control over that entity so that he can modify the expenses and profits as such. So in that case, this income would be clubbed. And when we apply clubbing provisions, students, it will go in the same manner, in the same head. It will not be added after gross total income. It would go in the same manner, in the same nature, in the same head as it would have been charged in the hands of the person receiving it. So here now salary which was received by Mrs. Anamika would be clubbed in the hands of Mr. Arun. So this 35,000 into 12 and standard deduction is also given. Please be very, very careful whenever you're clubbing or whenever there's a house property income to give such standard deduction. Standard deduction of 50,000 and usme standard deduction of 30% until and unless it is written computed. Computed means that this is the final salary which you have to pick. Okay? So you add the salary, then other income, total income Mr. Arun is 11 lakh and Mrs. Anamika income would be 420. And if Mrs. Anamika is qualified for job, then no clubbing. This 370 would be the income of Anamika only and Mr. Arun would have the income of 730. Anamika would have an income of 370 plus 420, which would be 790. Clear? If it is clear, I would request you to please attempt illustration 3 on the screen. And tell me the income of Binu and Babita. Shall I read the question? Mr. Binu holds 33% voting power in Yama Limited. Mrs. Babita is working as an accountant in Yama Limited, getting a salary computed. Now it is written computed, 3,60,000. Then you will not do that 50,000, okay? Without any qualification in accountancy, Mr. Binu also receives 32,000 as interest on securities. Mr. Babita owns a house property, which she has let out and rent received from 10 into 6,500. Now here, when you will take house property, you will do that standard deduction. Compute the gross total income of Mr. Binu and Mrs. Babita. And please write why you are clubbing, why you have taken so and so provisions. Please make a habit to write it in your answer sheet, because not only the answer is checked, your working notes, your assumptions are always given more weightage. Okay, so the correct answer for Mr. Binu is 392, including salary of Ms. Babita, and for Ms. Babita, the answer is 54,600. I hope each one of you has got such answer. Okay, now we move ahead. To the next part of clubbing income. One was remuneration. Next part is when you transfer the asset without adequate consideration, and that asset can be any asset. When I talk about spouse other than house property, let me explain it to you. Now please students, those who were thinking that this is easy, I would request for one very technical point to be again attentive on the screen. Okay, so next clubbing provision which we are talking about talks about transfer of asset for inadequate consideration or other than for an agreement of living apart, like in case of alimony, and other than for separate living. So what will happen? Now, first thing, how many of you remember, before I go into this section 64, how many of you remember house property ka section 27? Deemed ownership. Come on, try to reconnect. Quick. Sorry. So section 27 of house property says that when an individual transfer house property to his spouse or his or her spouse without adequate consideration or otherwise than in connection with an agreement to live apart, then the transferor is considered to be deemed owner. Then the transfer is considered to be deemed owner. So if Mr. X has transferred house property in the name of Mrs. X. Now, please, students, please apply all the sections which you know till date. So, clubbing provisions will not come into picture. Why? Because deeming provisions as per section 27 are coming into picture, which makes Mr. X the deemed owner. So Mr. X has transferred house property to Mrs. X for because of love and affection, and love and affection is not an adequate consideration. So there is no adequate consideration, and it is not for an agreement to live apart. So this house property, the deemed owner is Mr. X as per the provisions of section 27. Any income, rental income, would be taxed in the hands of Mr. X, not because of clubbing, but because he's a deemed owner. Not because of clubbing, but because he's a deemed owner. Answer, both cases mein you will get the same, but section which you are applying would be wrong. Okay, so what did I say? When we talk about deemed ownership as per section 27, any house property transfer, not any, the house property transferred by this individual to his or her spouse without adequate consideration or again without the agreement to live apart, then in that case the transferor is considered as the deemed owner, and hence any income would be taxed in the hands of Mr. X as deemed owner. Clear? But if Mr. X has given, say, some other asset, shares to Mrs. X for inadequate consideration and other than for the agreement to live apart, please take it as assumed. Okay, so Mr. X has transferred shares for inadequate consideration to Mrs. X. Now dividend income would be clubbed. Dividend income would be clubbed in the hands of Mr. X due to the provisions of section 64(1) clause 4. So basically, when the asset is house property in case of spouse, deemed ownership provisions are applied. But when the asset is other than house property, then clubbing provisions will apply. The essence of both are the same. The treatment would also, the answer would also come as same, but the section which you will be applying and the technical language which you will be writing would be absolutely incorrect if you quote section 64 in case of house property for a spouse. So if the asset is transferred for inadequate consideration to spouse, then in that case, the income derived from such asset would be clubbed in the hands of the individual. This is what my section 64, subsection 1, clause 4 says. Clear? Another thing, students, where we talk about clubbing provisions, we talk about clubbing of the income which has been derived from asset. Okay, not of the income which have been derived from the income of the asset. What did I say? This is called accretion of income. Mr. A transferred again shares to Mrs. X. Now shares yield what? Dividend. Okay, so this dividend would obviously be clubbed in the hands of Mr. A. But now what did Mrs. X did? This dividend, when was received, she again made an FD out of it. She made a FD out of it, and now this FD is yielding interest. Now this interest will not be clubbed in the hands of Mr. A. Only the income which is derived from the asset transferred would be clubbed, not the income which is derived from the income of the asset which is transferred. That would not be clubbed. Accretion of income, this is accretion of income. When you basically invest your income and then further on the income, that would not be clubbed. This would be taxed in the hands of Mrs. X. Clear? Next point which covers up here is when any asset, and that asset can be cash also, is transferred by individual to the spouse. So spouse of Mr. A would be Mrs. A. Okay. Mr. A has transferred the cash to Mrs. A. Mr. A has transferred the cash to Mrs. A, and Mrs. A has applied this cash as a capital contribution in a firm which is run by Mrs. A in the name of Messrs. A and C. Okay. What did I say? The asset transferred is cash for an inadequate consideration, and this cash has been applied as a capital contribution in a firm. So this has been invested in a business. Now what will happen? The income which is derived from such business, the income which is derived from such business would be clubbed in the hands of Mr. A, correct? But now suppose there is a capital contribution of X, Mrs. A also, and this indirect contribution, and there is a capital contribution of C and so partners. How will this income be clubbed? So this income will be clubbed on the proportionate basis, taking the opening capital contribution, the opening capital balances. We'll do a question, do not worry, but these are the cases which are covered here. Now, one thing you have to remember is the provision of section 56(2)(10), which is your gift received, in all these scenarios will not apply. Why? Because Mrs. X or Mrs. A are receiving the gift from the spouse, which is relative. So in any case, clubbing provisions obviously are attracted, but other sources income will not be attracted. Clear? So let's first, I hope there is no need of example in shares and house property, but there would be a need of example in this case, which is of Mrs. A giving cash. Let's do that. Everyone on the screen, please. Mr. Rahul started a proprietary business, okay, on 1st April 2019 with a capital of 6 lakhs. He incurred a loss of 3 lakh during the year 1920. This is the figures of 1920. To overcome the financial position, his wife, Mrs. Radha, a software engineer, gave a gift of 7 lakh on 1st April 2020, which was immediately invested in the business by Mr. Rahul. Now, first of all, before I proceed, what is the opening capital on 1st April 2020? What is the opening capital on 1st April 2020? 6 minus 3, 3 lakhs plus 7 lakh, 10 lakh. Very simple, sir. Loss is deducted from the capital. So 6 minus 3 lakhs plus 7 lakh, 10 lakh is the opening capital on 1st April 2020. And out of this 10, 7 is of, which is given by Mrs. Radha, and 3 is of Mr. Rahul. Moving ahead, he earned a profit of 5 lakh during the year 2021. Compute the amount to be clubbed in the hands of Mrs. Radha on assessment year 21-22. So I told you, when some gift other than house property is given by the individual to his or her spouse, then whatever income is derived is clubbed in the hands of the assessee. But here the income derived is what? The profits, right? So the profits would be clubbed. But how much of the profit would be clubbed? Proportionate based on the opening balances of capital. So 5 lakh would be proportionated in the ratio of 7:3, and so that would be clubbed. So 5 lakh into 3 by 10 would be Mr. Rahul's shares, because out of this 10 lakh, 3 lakh is of Mr. Rahul, and 5 lakh into 7 by 10 would be of Mrs. Radha. So this is how clubbing provisions would apply. Any doubt? So during the year, irrespective of the fact, whatever capital contributions has been done in, out, etc., maybe a question can come to confuse you that so many capital transactions happen, but what you have to consider is blindly the opening balances, nothing else. Very good, Sumit, Ambika, Gomati, very good. Okay, 1 second. Ramaya, in this question, clubbing provisions will not apply for the interest income because that is separate. Clubbing provisions, student, mostly adaptly have to be applied only in the cases where the person in whose hand it has to be clubbed has some sort of what do you say, taking a benefit out of it and not even being taxed in hands. That's why you club it. I am transferring something, I am transferring an asset, income from that should be clubbed in my hand if I've not received any consideration for it. As simple as that. This is my business. If you're receiving a salary from my business, that means this should be clubbed in my hands, because you do not have any qualification. Just because I run the business, I am taking the deductions of salary and claiming it on the other side. So that would be clubbed. But obviously, once clubbing happens, the same would be taxed in only in the hands of the assessee in which the clubbing has happened. You will not tax it again in the hands of the person who is receiving it. Any question in both the illustration which has been done? Let me just see. It's not that income from other sources would not be clubbed. Dividend is income from other sources. This first First of all, Radha is the individual assessee who has given the contribution to Mr. Rahul. So clubbing provisions will apply in the hands of Mrs. Radha, not in the case of Rahul. So this, out of the total profit of 5 lakhs, 3,50,000 would be taxed in the hands of Mrs. Radha, even if this 5 lakh was derived by the proprietary business of Mr. Rahul. But the major capital contribution, or the 7:10 capital contribution, 7:3 capital contribution came from Mrs. Radha, and that too as a gift which was given without adequate consideration. That's why clubbing provisions of section 64, subsection 1, clause 4 will apply. Any doubt, Ambika? Sumit, why did you ask that IFRS will not apply in case of clubbing? Any type of income would be clubbed, but please remember house property income in case of spouse only would be clubbed, not would be clubbed, it would be considered as deemed ownership of the transferor always. In the previous question, interest income was not clubbed, because that was obviously earned by Mrs. Babita. Sorry, Mr. Binu, Mr. Babita, so obviously I'm sorry, I did not read it. Mr. Binu. And house property income, maybe there is nothing given, automatically you will not club. Where there's an information given in relation to the individual and the spouse, then only you will apply clubbing provisions. If in case of profit there are interest and capital also, that will also be clubbed accordingly. All of the things will go accordingly. Okay, now last part. So we studied remuneration. When is remuneration clubbed? We studied when transfer of assets income is clubbed, when it is transferred for an adequate consideration other than house property. And the last part is you have transferred the asset to XYZ person. To XYZ person, and ultimately the asset ka benefit is even going to spouse, or the income of that asset is going to spouse. That would come as an indirect benefit to spouse, and hence clubbing provisions will happen in the hands of the assessee. From example, sure. So if Mr. A, instead of making a transfer to the spouse, because direct transfer to 6414 mein aa gaya, what he did, Mr. A transfer for an inadequate consideration to, say, Mrs. Z. This Mrs. Z is some XYZ person, okay? And Mrs. Z ultimately he transferred what? Let's assume he transferred shares again. And the dividend ultimately Mrs. Z is giving to Mrs. X only. Now, when prima facie on document, the assessing officer see he has transferred shares to Mrs. Z. So why should dividend income would be clubbed? Because Mrs. Z is not the spouse. Fine. Now what has happened? He see Mrs. Z has indirectly transferred the income to wife of Mr. A, which is Mrs. X. Okay. So in that case, also clubbing provisions will apply, because an indirect benefit to spouse will also be covered under clubbing provisions. Again, students, I'll repeat, only the clubbing provisions which are considered here are the one in which clubbing would apply. Otherwise, no other clubbing automatically will arise. I'll give an example at the end of this chapter that suppose an asset has been transferred to daughter without adequate consideration. Clubbing provisions will apply? No. Only spouse and son's wife are covered here. Okay. So that's only the one which are covered in this chapter, other one where clubbing provisions you will apply, otherwise not. So again, the last clubbing part is when you transfer without adequate consideration to any person or association of person an asset, the benefit of which would be ultimately derived by the spouse indirectly, then the income of such would be clubbed in the hands of the assessee. Clear? Any doubt in clubbing of assets in case of spouse, clubbing of income in case of spouse? Okay, Sumit asked, Sumit has asked that there is Mr. A and there is Mrs. A. Mrs. A has a saving account, okay, in which the money is deposited by Mr. A. So some 10 lakh rupees were deposited in Mr. A and already had a higher income. So he deposited in saving account of Mrs. A. Now whatever interest income is being derived would be clubbed in the hands of Mr. A. Clear? But suppose if from this interest, Mrs. A has made an FD and that FD is again yielding interest, that interest would be clubbed not at all. This would be taxed in the hands of Mrs. A only. Clear, Sumit? So ultimately, whatever you're transferring and whatever that transferred asset is generating as an income would be clubbed. That's it. Whether it is transferred as a not house property, as a shares and earning dividend, whether it has been given as a contribution to the business of the spouse, anything given for inadequate consideration would be clubbed. House property के case में deemed ownership, please do not apply section 64. Again, I'm saying repetitively. Clear, Sumit? Now we move ahead to clubbing provisions in case of son's wife. In case of son's wife. Now, whether daughter, father-in-law, mother-in-law, anyone who transfers asset without adequate consideration, without adequate consideration to son's wife or son's spouse, then clubbing provisions would be attracted in the hands of the transferor. And again, clubbing happens only in case of asset transfer without adequate consideration or indirect benefit to son's wife, which is just like spouse. Totally same hai, but instead of spouse, now you have to understand all the scenario as per taking son's wife. So now Mr. A had a daughter-in-law who was Mrs. C. Okay, and Mr. A transferred a house property. Now here house property के case में, in case of son's wife, section 64 would apply. Section 64 would apply because deemed ownership may only minor married daughter and your wife is covered, otherwise no one is covered. So here if Mr. A transfers house property to Mrs. C, then any rental income derived from such house property or even the gross annual value of such house property would be taxed in the hands of Mr. A. Would be clubbed in the hands of Mr. A. And Mrs. C के लिए it would not be a gift taxable. Why? Because she has received it from the lineal, as in father of the spouse, which is a relative as per your section 56 to 10. Okay? Again, I'll repeat, any asset transfer for inadequate consideration to son's wife, then in that case, the income from such asset would be clubbed in the hands of the transferor. Mr. A can transfer, Mrs. A can transfer. In both the cases, clubbing provisions will apply in the hands of transferor. Again, if you have transferred, same accretion income concept, same, and rental income would be clubbed, but out of rental income, she's earning some other income, that would not be clubbed. Again, here she has invested that amount in business, same. As per the opening balances, the profit or interest on capital would be clubbed. If it's a partnership firm, profit would not be clubbed because exempt incomes are not clubbed. Okay? Another thing, Mr. A transferring it to Mr. C, who is his son, a house property. Clubbing provisions will apply, yes or no? Whether clubbing provisions will apply? No, because there is nothing as such given in section 60 to 65. Deeming provisions will apply as per section 27? No, section 27 says spouse. Then what will happen? Simple, nothing. He has gifted a house property and he has received it from relative. There is no tax implications, correct? Now, Mr. C giving it to Mrs. C. Mr. C giving it to Mrs. C. As in the son is giving now to his wife. Then clubbing provisions will apply? Yes. For inadequate consideration, he has given it. Which section would apply? Whether section 64(1)(4) would apply or whether section 64(1)(6) would be applied. So section 64(1)(4), which is inadequate transfer to, obviously it's a house property, then naming provisions will come. But suppose this is shares. Transfer for inadequate consideration by spouse, by an individual to his spouse would come under 4. This is not a case of transfer to son's wife because here this is not an indirect transfer. He has transferred it. This is a normal case. Okay? So please be careful by applying the provisions. But again, or you can take indirect transfer, but indirect transfer, then you will apply section 64(1)(6). That you have to be careful. And same case is given in your books also, where Mr. A transfers an asset to Mrs. A, spouse of Mr. A, and Mrs. A transfer it to Mrs. C, son's wife. So now here you can give the answer as clubbing provisions will apply in the hands of Mr. A, either applying section 64(1)(6), okay, which is indirect transfer to spouse, or you can apply it. So this is there is 8 which would come, or you can say section 27 will apply on such transfer. If it's a house property, then Mr. A would be taxed for such house property, and then when it is transferred to Mrs. C, again Mr. A would be taxable because it is being transferred to son's wife. So in both the cases, the same provisions would apply. Let me just show you. 1 second. On the screen, please, students. Mr. A has gifted house property valued at 50 lakhs to his wife, Mrs. B, who in turn has gifted the same to Mrs. C. When it is gifted, that means inadequate consideration. Their daughter-in-law. The house was let out at 25,000 per month. Through the year, compute the total income of Mr. A and Mrs. C. So first, you can say the first part of the question can be transferred like the provisions of section 64(1)(6) directly to include the income of 210 arising to Mrs. C in the hands of Mr. A without first applying the provisions of section 27 of deemed ownerships, because section 64(1)(6) speaks of clubbing of income arising to son's wife from indirect transfer of asset to her by her husband's parent without consideration. Gift of house property by Mr. A to Mrs. C via Mrs. B can be viewed as indirect transfer by Mr. A to Mrs. C. Either you can take it as indirect transfer or you can apply two provisions. One, you would apply section 27. As per section 27, an individual who transfers house property for inadequate consideration to his spouse not being in connection with an agreement to live apart shall be the deemed owner. So when the transfer has happened between Mr. A and Mrs. B, Mr. A would be considered as deemed owner. Then what happened as per section 64(1)(6), income arising to son's wife from asset transfer directly or indirectly to her by individual otherwise than by for an adequate consideration would be included in total income of such individual. So then again, clubbing provision of section 64(1)(6) can apply. So basically, you can directly, without going to all this case, what you can do is, if I'm talking about house property, one approach, if you want to show that you know all, you can apply first section 27, taking it as deemed owner, and then section 64(1)(6). Or you can directly cover this transfer as indirect transfer and cover it under section 64(1)(6). Totally your wish how to write it in an exam. But please be very careful on your sections. Clear? Again, other things remain same. Aggregated income, invested in business asset, everything remains the same. And transfer to son is not covered. Transfer to daughter is not covered. A major son and major daughter is not covered. Take your time. See, Sumit says in case of gift to relative under section 56(2)(10, then will these clubbing provisions will apply? First of all, the clubbing provisions which we are studying for in case of individual covers relatives, spouse and son's wife, and then there is minor son, minor SSE. All of these are relatives, so in any way section 56(2)(10 will not apply. Directly clubbing provisions will apply. And if section 56(2)(10 is getting applied, clubbing provisions will not apply. Think of any scenario where both of are applying. I don't think so. There is one. Okay. Someone have asked, again Sumit has only asked that why only first income is clubbed, why not accreted income is clubbed. Now students see, again the idea is to cover the intention where they have transferred it, the asset, just to divert income. Okay, but the obviously income will always be invested, and then again that income would be invested, because income never goes uninvested. So till what line will you go and cover all these clubbing provisions? Okay, so only the income which has been derived from such asset is clubbed, not an income which is derived from the income of such asset is clubbed. Always remember this. And the last, again, just like indirect transfer to spouse, section 64(1)(7)(8). 7th is there, covers indirect transfer to spouse. So if I've transferred something to Mr. Suppose Mr. A has transferred an asset to AOP, and that AOP is giving the income to Mrs. C, who is the daughter-in-law of Mr. A. That is a case of indirect transfer, and clubbing provisions will apply accordingly. Clear? Any doubt? Please, sons pay and unsub pay, please do not apply clubbing provisions. Next is relationship which is covered under clubbing is for minor. Minor. All income of minor are clubbed in the hands of parent. What did I say? All income of minor are clubbed in the hands of parent. Which parent? Who has the higher income? Who has the higher income excluding this minor income? Who has the higher income excluding the minor income? And once this thing happened, in the subsequent years also it would be clubbed in the hands of that parent, even if in the later year the other parent has the higher income. Number one. So if first year of clubbing, Mr. A has an income of 5 lakhs, Mrs. A has an income of 4 lakhs. Okay, this is your first year when their minor son ka income has to be clubbed. In whose hand you will club? Mr. A hand. Now in the next year, if Mr. A's income is 6 lakhs and on the other hand Mrs. A income is 7 lakh, in whose hand you will club? Again Mr. A. Until and unless assessing officer thinks that it is necessary to do so into the other parent, till that time you will not club it. Till that time you will not clubbed it. And what did I say? All the incomes have to be clubbed, but in two scenarios, the income would not be clubbed. Number one, when that income is derived from special talent, specialized knowledge, or skill of this minor. So basically, where clubbing is basically happening, where you intend to divert your funds in the name of minor, and minor is earning income. Like most commonly, people make it FD in the name of minor. So that interest is to be clubbed in the hands of parents. But if your minor son or minor daughter is having some income from the special talent, that means you did not have an intent to evade tax. You did not had an intent to evade tax. Sorry, you did not have an intent to evade tax. So why clubbing would come? So this, whatever be recently KBC where there was a student peak, right? So whatever income that minor has earned from their special knowledge, skill, talent, etc., that will not be clubbed. So if they go and participate in Jhalak Dikhla Ja or Indian Idol and they earn some money out of it, they will not be clubbed. If they act in movies and earn some money out of it, the income would not be clubbed. And secondly, when we're talking about a minor who is suffering from severe disability and his income has to be taxed under 80U, the benefit would be derived under section 80U, then the income is not clubbed. So person with severe disabilities income is not clubbed, and what is derived from special talent is not clubbed. Now you will ask, ma'am, whether adopted child are covered, whether stepchildren are covered, all of them are covered. Ma'am, if parents are divorced, then in that case, then the person who maintains the child In that case, the income would be clubbed with that parent, even if the other parent has higher income. Even minor married daughter will also be covered here. Even minor married daughter will also be covered here. But this clubbing provisions give one benefit under section under section 1032, that for each child whose income has been clubbed, you will get 1500 as deduction, or the income whichever is less. So 1500 would be exempt. I should not write the word deduction. We're talking about section 10. So 1500 would be exempt. 1500 or the income on whichever is less. So let's take an example. So here Mr. Arvind has 3 minor children, 2 twin daughters, 1 son. Income of the twin daughter is 2500 per annum each. Twin daughters both have 2500 and the son is 1200. Compute the income. So 2500 is clubbed in the hands of Mr. Arvind, but each child 1500 exemption. So 2500 into 2, 5000, and each child 1500 exemption. 3000 is the exemption. Okay, but for the son only 1200 is the income, so 1200 would be the exemption. 1500 or 12 income on whichever is lower would be the exemption. Clear? Any doubts? Next is a case of cross transfer. The cross transfers are very interesting. Now, again, people think that Income Tax Act has made certain rules, certain sections. Let's just try a loop hole into it. Now, what happened? There is Mr. A. He transferred debentures to Mrs. B. Mrs. B is totally unrelated. She's a spouse of Mr. B. And on the other hand, Mr. B transferred shares to Mr. A's minor son. What did I say? Mr. A has made a transfer to Mrs. B, spouse of Mr. B, and Mr. B, on the other hand, has made a share transfer to Mr. A's minor son, both being almost of the same value of, say, 50K. Now, prima facie, up to whatever clubbing provisions we have read, they say no income is getting indirectly benefit. Okay? They say transfer of income to spouse or to son's wife or to minor son would be clubbed, right? Now here Mr. A has transferred to Mrs. B and Mr. B has transferred to Mr. A's minor son. How to apply clubbing provisions? But Income Tax Act says, I'll read the line which you always have to remember it. Income Tax Act says that this would be a case of cross transfer and clubbing provisions would be applied. Why? If the transfers are so intimately connected that they form part of a single transaction and each transfer constitutes consideration for the other by being mutual or otherwise. They have done it so that they do not come into the radar of the Income Tax Act, income tax authorities. Okay? They have done it so that Mr. A and Mr. B sat and say, let's take a loophole. I will transfer to your wife, you transfer to my son. We are equal. Okay? But Income Tax Act says that you have find a way of making a transaction in such a indirect manner or in a long manner just to evade tax. Just to evade tax would be considered as cross transfer, and in this case, whatever income Mrs. B is deriving from debentures would be clubbed in the hands of Mr. B, and whatever income Mr. A's minor son is deriving from the shares would be clubbed in the hands of Mr. A. ठीक है, शेयर्स का इनकम वुड बी क्लब्ड इन द हैंड्स ऑफ मिस्टर ए, डिबेंचर्स का इनकम नहीं, ठीक है, शेयर्स का इनकम वुड बी क्लब्ड इन द हैंड्स ऑफ मिस्टर ए, डिबेंचर्स का इनकम वुड बी क्लब्ड इन द हैंड्स ऑफ मिस्टर बी. So this is a case of cross transfer which was decided in the case of CIT versus Keshav Moraji. You should remember this case law. Keshav Ji Moraji. Clear? Cross transfer clear? Okay, Ramaya, good question. Ramaya says that once section 27 has applied, do we have to consider section 64 again for house property? The answer is no. Section 27 say you have considered that person as a deemed owner for house property, then why clubbing would come? Because he is the owner in the books. He is the owner as per the tax authorities. But if there is some other asset where the owner is still the spouse, then clubbing provisions will apply. So generally, student, the person has asked, can the CC take the TDS credit of minor, and how, since the PAN is different? Now, number one, where we talk about FD, etc., people know that clubbing will happen, so they tend to give the parents tend to give their PAN only. And when we talk about special skills wala income, that in any case would be the income of the minor only. So usme minor PAN goes, and just in case this happens that clubbing provisions happen and minor PAN is quoted, there is always in your form that when you're claiming TDS, when you're claiming when you are showing the income of other person, you can claim the TDS of the other person. There is that part in your form to do so. Any doubts from this up till now? And students, all these incomes which we are discussing, income, if you're clubbing the income, then you have a right to club the losses also. If I'm clubbing the house property income of son's wife, so any loss because of interest taken on from that property would also be clubbed, and exempt incomes are not clubbed. So the last part, when an individual transfers a property, please listen, for an inadequate consideration to HUF. That means an income, individual ka own property is now HUF ka property. Individuals ka own property is now HUF ka property. What will happen is individual ka property is now HUF ka property and he has transferred it for inadequate consideration. Then whatever income is derived from such property would be clubbed in the hands of individual. So any transfer of property for inadequate consideration by individual to HUF would be clubbed. The income of the same would be clubbed in the hands of individual. Clear? Yes or no? This is what my section 64.2 says. Now, it is easy to understand and people do understand this part. Now, here, iska subsection, iska next clause says on partition. Now, what has happened? Total or partial. Individual has transferred a property to HUF, right? Income was clubbed in the hands of individual. Till the time HUF is the owner. Now, what happened? HUF got partitioned. Now, partition may, as per generally law, each member gets the share. Each member gets the share of that property. So obviously individual must have got it. That's fine. So other member would have also got it. Now the spouse of individual would have also got it. The spouse of individual would have also got the property share on partition, whether total or partial, right? So the Income Tax Act says if the spouse of individual has received on partition a part of property which was transferred by individual to HUF for inadequate consideration, then any income which has been received from such property would be clubbed in the hands of individual. So they say that this is a typical case of indirect transfer of property to the spouse. So in that case, income would be clubbed in the hands of individual. Clear? Again, I'll explain. You transfer the property to HUF. Now, till the time the properties of HUF, clubbing provisions are being applied because inadequate consideration. Now on partition, whatever your spouse receives the share of such property, income from that would also be clubbed because it is considered as indirect transfer of the property. Clear? Yes or no? Sure. So this is what is about HUF. So again, students, if I talk about section 61 and 64, 61 specifically talks about revocable transfer. There, any person, any SSC, any person can be the SSC, a company, an AOP, anyone. But section 64 talks only about individual and does not say whether revocable transfer or irrevocable transfer, it is immaterial. They see only whether consideration is given or not, or whether you have a substantial interest in case of remuneration. Clear? Last section, which is your section 65. Now, section 65 says, we know clubbing provisions where income has to be clubbed in the hands of transferor, right? But the assessing officer has a right to issue notice to the transferee to pay the tax on such liability. What did I say? Clubbing provisions happens and the liability is of the transferor to pay the tax on it. Correct? But section 65 may liability in respect of the person on whose income has been included, unko bhi notice can be issued to pay the tax, and if the notice has been issued to pay tax on such income, then they have to pay tax. They cannot say ki jao usse le lo, it is not getting a tax in my hand, it is getting clubbed in his hand. No, if the income tax has issued you the notice, then you have to pay the tax. You will always be in a way have a cloud of liability on you. Clear? So now any doubt from section 60 to 65 of clubbing provisions? In case HUF transfers to individual, no clubbing provisions. Again, students, you will ask, in case individual transfer to his major son or his major daughter, clubbing provision will apply? No, it will not apply. Only strictly the ones which we discussed and are covered here. Again, I'll say in case of spouse, remuneration of a substantial concern, any asset for inadequate consideration, or any asset from which the spouse has indirect benefit would be clubbed. In case of son's wife, any asset for inadequate consideration, or where she derives indirect benefit. And in case of minor, all the incomes except the one which are derived from special talent, and if the minus has severe disability as per your section 80U. And in case of HUF, clubbing will happen if you have transferred a property for inadequate consideration. Beside these, nothing would cover. Obviously, you have to keep in mind the provisions of cross transfer. So this is it for clubbing provisions. I am glad we have covered one chapter. Any doubts, you can give it in the break time. On the other side of the break, we start with chapter of set off and carry forward. Till then, please hydrate yourself and come up with the next chapter. Any questions, obviously you can ping me during the break. Thank you. Jay sir? Welcome after the break, everyone. So now we are starting with our other chapter, which is the chapter 10, aggregation of income, set off and carry forward. Now, before we go, this one question which I'd like to answer for Ramaya. Transferee was not actually liable to pay tax, but it is liable to do so as per section 65. Will the transferor get will the transfer get liable to reimburse the amount to transferee? See, again, these reimbursement things and all is just totally a part of understanding. Obviously, if you're transferring some asset for inadequate consideration and paying only a tax out of it should not matter. The reimbursement part is nowhere to be dealt with, or it's just an understanding which comes automatically. The focus, see, the focus of section 65 is that I am not liable to pay, you just go and take it from him. Still, what you say, a fear of getting noticed by the assessing officer still always prevail. Okay, so on this note, we shall begin with our section 6, chapter 10, aggregation of income, set off or carry forward. Very simple chapter. Some topics really need attention. We'll do each one of by one. So to give you an overview of this chapter. One second. I cannot share the screen. Just 1 second. So first, students, if you just notice on the heading of the chapter heading says aggregation of income, set off or carry forward of losses. Now, set off or carry forward of losses, obviously I understand you people know, but what do you mean by aggregation of income? And this is something which people do not tend to ask themselves. What is aggregation of income? Anyone want to give a rough try before I tell what is aggregation of income? It is not opening of gross total income, totaling of gross total income. What do one mean by aggregation of income? So how many of you remember chapter 1? Chapter 1 may you did certain sections of section 68, 69, 69A, undisclosed income basically, 69B, 69C and 69D. But these are actually added in your income but are not your income. These are not in the nature of income. These are in the nature of some unexplained investments or unexplained sources which you do not give a sort of satisfactory explanation to assessing officer, right? So then he in turns add these in your income. So this addition of such undisclosed sources of income along with other income is called aggregation of income. Okay, so I hope now you will remember what is aggregation of income, but that is just one part of the heading done. Now coming to the other part, set off and carry forward of losses. Now let me just give you an overview of how this looks. So there are sections from 70 to 79 and then there's 80 section. What these section covers, first section 70 and 71 talks about set off, where we will be understanding so where we will be basically understanding your intra-head adjustments. and your inter-head adjustments. Okay, inter-head is covered in section 71, intra-head is covered in the 72 under section 70. I know at your stage you know that once set off does not happen, the same is carry forwarded and then it is adjusted in the next year. So each once a loss is not able to adjust with the income of that year, it is carry forwarded. Now carry forwarded, once it is carry forwarded, it is only adjusted with this within the same head, except unabsorbed depreciation. Within the same head it would be adjusted. When I say within the same head, each head has a separate section for it. 71B for house property, business loss 72, speculation business 73, specified business 73A, capital gain 74 and raise horses 74A. Business losses में other sections हैं which you have to remember is in case of amalgamation. These are important sections. This is a section which is new, not new, amendment. Basically, the whole section has been substituted. Then change in constitution of firm, change in substantial shareholding and return filing mandatory. This is all what we'll be doing in next 1.5 hours. So now, first, let's start with set off and then step by step go to other sections. Okay, so now if you have losses, the income tax says that you can adjust that losses. Set off means adjustment of losses with income or profits. Okay, so the income tax act says adjust such loss. Now take a scenario. You are a family member of 4. One has some problem of losses. From whom they will borrow the money? The one who are there in their house. Okay, so similarly, when a loss happens in a head, in a particular head, under a particular head, that would first be adjusted with the income of that head. That would first be adjusted with the income of that head. This is commonly called as intra-head adjustment or inter-source adjustment. Inter-source means within the same head among different sources, you are making an adjustment. Or intra-head, just like intra-school competition means within the school, just like intra-head means within the same head you are making the adjustments. So intra-head adjustment, first of all, whenever the loss incurs, you look for the resources around you, and that is why under the same head. So just like a loss from business A can be set off from the profit of business B, loss of house property A can be set off with the profit or income from house property B. This is what is my inter-source or intra-head adjustments. Having said that, there are certain restrictions on which you cannot make inter-source or intra-head adjustment. First is your loss from speculative business. They say loss from speculative business can be adjusted only and only with the profit of speculative business. So if I have 2 speculative business, one is loss, one is profit, I can adjust it. But if I have one normal business, one my speculative business, I cannot adjust the loss of speculative business with the profit of speculative business. Again, students, these are the restrictions of adjustment of such losses with other income. But income, if there is a loss of non-speculative business, that you can adjust with profit of speculative business. That you can adjust with profit of speculative business. The loss of it cannot be adjusted with the profit of the other. What is speculative business? If you remember, we did it in your PGBP last class. Speculative business is a business in which there is no actual delivery. Basically, sale and purchase of shares with no actual delivery, or sale and purchase of securities with no actual delivery. Intraday adjustments. Intraday mein where you sell, so you have to set it off with buying the same. But if I do sale and purchase of shares as an investment, that would be my capital gain income. Again, usme bhi speculative thing can happen. Or if I take sale and purchase on everyday basis, I do sale and purchase on everyday basis without actual delivery, that would be my speculative income. If I do sale and purchase, it's my business to do sale and purchase of shares, but with real delivery, that would be my business income. So to at your level, you should have a distinction between speculative business income and when the same is a non-speculative income. Yes, aggregation will obviously happen after clubbing. Next, so speculative business loss, you cannot set it off with some other business. Loss from specified business can also not be set off with some other business, but yes, specified business loss can be set off with a business which is specified, even if it is not eligible for deduction. Remember, we did that in 35AD. So specified business loss can only be set off from the income of the specified business. Loss from business of owning and maintaining race horses cannot be set off against any income other than the income of owning and maintaining race horses. Now, number one, when we are on this, other sources mean if you have lotteries, basically your casual incomes or winning or gambling winnings, all of these के साथ, these are directly taxable. You do not adjust any income from these. You do not adjust any income from these. There is no adjustment. Secondly, undisclosed sources, which we just discussed, which are taxed under section 115 BBE, usme bhi you do not make any adjustments. From that also, you do not make any adjustment. These have to be taxed at flat rate without set off of any losses, without any deductions under chapter 6. So never take lottery and loss from owning and maintaining race horses and set it off. Okay, so loss from owning and maintaining race horses can be set off only from the income out of it. Loss happens when obviously maintaining race horses take a huge expenditure, and when you have earned the stake money which is less than that of your expenditure of maintaining race horses, then there would be a loss from it. Okay, no loss can be set off against income from winnings, crossword puzzles, lotteries, which we just discussed. Long-term capital loss. Long-term capital loss can be set off against only long-term capital gain. But having said that, short-term capital loss can be set off with both long-term capital gain and short-term capital gain. What did I say? Long-term capital loss can only be set off with your long-term capital gain. Why, students? See, even if you will analyze these restrictions basically obviously speculative business ko why should we allow with some other business? Specified business all together has capital expenditure deductions. Why should that be set off with any other business? Maintaining resources again only specifically with resources. Long-term capital loss is taxed at a flat rate of 20%. Why it should be taxed with why it should be adjusted with a income which is taxed at a lower or a higher rate. So long-term capital loss only with a long-term capital gain. Short-term capital loss with both of them. Clear? Inter-head adjustments clear? Intra-head adjustments clear? Now once after making intra-head adjustments, still there is a loss under that head. What did I say? Still there is a loss under that head. You will go to some other head. आपने अपने घर से पूछा, you asked help in under your house, now you did not get it, you will go help for outside. Similarly, loss not adjusted under the same head will be adjusted from other head in the year of occurrence. Again, I'm saying in the year of occurrence. Now, after making intra-head adjustment, the next step is inter-head adjustments. So if in any year the taxpayer has incurred losses under one head of income other than capital gains and is having income under other head including capital gains, then he can adjust the loss from one head against income from the other head. Like loss from house property can be adjusted with salary income up to 2 lakhs. Again, I said, if there's a loss from business, I can adjust it from house property income. If there's a loss from a business, I can adjust it with capital gain income. So if there's a loss from business, I can adjust it with other sources income, but I cannot adjust it with salary income. So these are the restrictions of inter-head adjustment. That means inter-head adjustment is allowed after intra-head adjustment. It is allowed, but these are the restrictions which you have to keep in mind. Number one, loss from business and profession cannot be set off against income chargeable to tax under the head salaries. Business and profession ka loss, you cannot set it off with salaries. No, not at all. Loss under the head capital gains cannot be set off under with any other income. Whether it's a short-term capital loss, whether it's a long-term capital loss, you cannot set it off with any other income. But you can set it off the loss of business with your capital gain income. Capital gain loss cannot be set off with your other head's income. Loss under the head house property shall be allowed to be set off against any other head of income only to the extent of 2 lakhs for any assessment year. However, unabsorbed loss shall be allowed to be carry forwarded for set off in subsequent years as per the provisions which are discussed later. So we'll do the questions, do not get confused. House property loss, yes, you can go and adjust it with any income, even salary. But when you go and adjust house property loss with any income, you can adjust only up to 2 lakhs, up to 2 lakhs. So suppose there's a loss of house property of 6 lakhs, I can adjust only up to 2 lakhs with other incomes. Even if I have a lot of income, the remaining 4 lakh will be carry forwarded. The remaining 4 lakh will be carry forwarded and adjusted with house property next year. Loss from business of owning and maintaining racehorses, loss from speculative business, loss from specified business, all of them would be not be set off against any income. Obviously, intra-head adjustment is not allowed for them, while inter-head adjustment would be allowed. And second thing, student, loss from any exempt source will not be adjusted because when the income is not taxable, the loss will also not be claimed for. Clear? Now we'll do one question and then I will take each one of yours doubt. And any part which remains unadjusted gets carry forwarded. So let's do one question for the same. Mr. Kamal, please try attempt it, okay? Mr. Kamal, age 35 years, submits the following particulars pertaining to assessment year 21-22. Income from salary computed, income loss from self-occupied property, loss from let-out property, business loss, bank FD interest received 85,000. Please attempt, students, and tell what is the total income. When I say 2 lakhs of loss, that means 2 lakhs of total loss from house property. Students, always first thing is to make intra-head adjustment, then to go for inter-head adjustment. You cannot directly go for inter-head adjustment before applying intra-head adjustments. First, you have to check it off within the same head, then you go to other heads. Can short-term capital loss under 11A be set off against long-term capital loss under 112A? Yes, it can. Short-term capital loss can be adjusted with long-term capital gain. First of all, question comes, can we set off casual income from casual loss? Example, loss of lottery and gain on lottery. Now, first student, if you have studied other sources of income, you must have known that casual incomes, all of these are taxed at gross rate. There is no deduction or of any expense. There is no loss which has to be taxed. There is no loss which has to be recognized. Okay, so lotteries, etc., do not have any losses. Only is the gain part. Permissible deductions you must have studied in section 57. Usme you must have studied that. So I've got the first answer and that is absolutely correct. Total income of 220. Now students, out of the salary of house income of salary, I can adjust only house property loss, that too up to the extent of 2 lakhs. The remaining 22,000, which is 150 plus 72, would be carry forwarded. I can, even if I have salary, I cannot adjust business loss from it. Yes, but business loss can be adjusted with other sources of income, 85,000, and the remaining loss of 35,000 would be carry forwarded. So total income is of 220. Clear? And please, please remember writing in notes the losses which are not adjusted. Please write it in notes that this part would be carry forwarded. Either you can show it like this here, or you can write it in notes. Now again, I'll repeat. Head may one head to another first adjusted. Again, this is mandatory. Neither you as an assessee nor the assessing officer can deny of adjustments or set off. If it is to be adjusted, it would be adjusted, and in the same order. First interhead, then intrahead. Now, if the head gives me the loss, then I will adjust it with other heads of income, keeping in mind the restrictions. Now, if it is still not adjusted, still it is left, what will happen? The thing which happens is called carry forward. You will carry forward it. Now, each loss once carry forwarded is adjusted under the same head. Then interhead adjustment, inter-source adjustment only happens, or you can say intra-head adjustment only happens, no inter-head adjustment. So same head may only I can adjust it, or the unabsorbed depreciation can be adjusted in all heads except salary. This is there in section 32.2. Okay, please write these small things which I tend to say, because these are the things which are your red flags. So now once one second. One second. Now, once your inter-head adjustment happens, now you will carry forward it. If there's a loss, now carry forward I told you it would be adjusted with the same head. Now, section 71B first talks about adjustment or carry forward and set off of house property loss. Now, house property loss once carry forwarded can be adjusted with house property. It can be carry forwarded for 8 succeeding assessment years immediately following after the year when such loss was incurred. It's not 1 plus 7. You incurred the loss today, you can carry it for 8 succeeding assessment years. So in this example, which we just took, 2 lakh is got set off, so the remaining 22,000, even if we have income or not, the remaining 22,000 would be carry forwarded to the next year. So this can be carried forwarded for the 8 assessment years. Return filing का part I will come एक साथ सब पे, ठीक है? So simple house property loss, yes, can be carry forwarded, and can after carry forwarded can be adjusted only with house property income to any extent. Within house property, you can make an adjustment of any extent. Say for example, let me give you an example. For assessment year 2021, or first take assessment year 1920. Let's first take assessment year 2019-20. There was an income under the head house property only saying of 4 lakh. There was a loss of 2 lakh. You adjusted it 2 lakh, no issues. Okay. Then assessment year 2021 में income from one house property 6 lakhs. Loss from other house property 4,50,000. Can you adjust it? Yes, you can adjust it. It is not that within house property, you can adjust it to any extent. You can adjust full, and 1,50,000 would be taxable. Now, suppose instead of this 450, the loss would have been of 750 or say 850. So I would have adjusted full 6 lakhs from house property, full 6 lakhs from house property. So under house property, the income would be nil. And now the remaining 2,50,000, suppose I have salary of 3,50,000. Suppose I have salary of 3,50,000. I can adjust only up to the extent of 2 lakhs. 1,50,000 will go here as taxable salary, and the remaining 50,000 would be carry forwarded to next assessment year. Clear? Any doubts? Now cut to assessment year 21-22. Assessment year 21-22. What has happened now? I have a carry forward loss of 50,000. Right. Now in this year, suppose under the head house property, be careful and listen. Okay? I have an income of 6 lakhs. I have a house property loss of 3,50,000. First of this current year, I will make an adjustment. Yes, now remaining I have 250. Now out of this 250, out of this 250, which was carry forwarded, 50,000 would be adjusted. First, you will not make an adjustment of 50,000. You will make an adjustment of current year loss. Okay? So now the taxable house property income would be 2 lakh. Another scenario, income from house property in assessment year 21-22 is just 5 lakhs. Loss from house property is 2 lakh 50, or say not 2 lakh 50, 6,50,000. Then what will you do? First, you will adjust this year loss. You will adjust current year's loss. So 5 lakhs minus 6,50,000, full adjusted 1,50,000. This year's would be adjusted with other income. Other income, suppose I have salary, that would be adjusted. This 50,000 would now be carry forwarded to assessment year 22-23. It will not be adjusted with salary. Why? Because once a loss is carry forwarded, only with same head. So you will say, ma'am, why should not we first adjust this year? First adjust the carry forwarded loss? No. The rule says first you make the adjustment for current year loss, then you make the adjustment for the one which you are carrying forwarded. First you take your own baggage, then you remove the baggage which you are carrying on. Okay, so please be very careful. You may have incomes to set off the losses, but you have to see the restrictions to set off the losses. Clear? And same things apply for all adjustments. Sumit, I hope I answered your question. Adjustment is mandatory. You cannot just merely carry forwarded or just adjust it and not carry forwarded. Correct, Ramya? You can absolutely say that for house property, set of 2 lakhs is the limit if the in the incurring of loss with the other heads. Once the loss has been carry forwarded, you can carry forward it to any extent and adjust it in house property. So giving a question to your answer, suppose I have an income for assessment year 21-22. I have an income only, no other income. I have an income of 5 lakhs, or just say I have under house property, profit of 5 lakhs or income of 5 lakhs, better, loss of 11 lakh. To let out property, this is a loss of 11 lakh. 5 lakh, set it off here. Nothing is taxable under house property. Nil taxable. Yes. Salary income say maximum adjusted 2 lakhs, or other income say maximum adjusted 2 lakhs. And my salary was say 2,40,000. 40,000 taxable. That's it. Now how much is remaining to be carry forwarded? 5 lakhs, we say 5 adjusted here, 2 adjusted here. 3 lakh will be carry forwarded. Now this 3 lakh would be adjusted from house property only. There is no adjustment amount ka limit for carry forwarded loss. Clear? Next is your set off and carry forward of business loss. Now, first thing, business loss, when I'm talking about section 72, I talk about non-speculative business loss. Non-speculative business loss. So if a loss of any business profession other than speculative business cannot be fully adjusted in the year when it is incurred, it would be carry forwarded. On carry forwarded, it would be only adjusted with PGBP. And this loss can be carried forwarded for 8 immediately succeeding years after the year of loss. These provisions are for losses, not for unabsorbed depreciation. Unabsorbed depreciation section 32, which you will apply. Now here, what type of question comes are, your first question is, only the person who incurs the loss can carry forward and set it off. So suppose I was running a business of textile. I was incurring loss. I transferred that business to some XYZ person. That person cannot carry forward the loss. Even if I've transferred the exact same business, exact same condition, he cannot carry forward my loss. He cannot carry forward my loss. Only the person who incurs the loss can carry forward and adjust it. Yes, the exception is inheritance. Suppose my son gets that business, he can carry forward the loss for the unexpired period. Again, I'll repeat, only the person incurring the loss would be allowed to be carry forwarded. Exception is inheritance, succession by inheritance. Also, I can set off a business loss even if the business is discontinued. Even if the business is discontinued. I was running textile business. I did not see any profit in it in the future. I closed the business and now I'm running a food corner. So I can adjust the unexpired business loss of textile business with my food corner. The carry forwarded part can be adjusted. Discontinuous can happen, but the assessee should remain the same. There is amalgamation. Amalgamation, demergers के case में section 72AA, 72AB and 72A3 comes into picture, which I'll do after all these losses. ठीक है? Any doubts? Okay. So house property loss 8 years, business loss 8 years, condition is same assessee. Next is your speculation business. Speculation business loss can be adjusted with only speculation income. If it cannot be adjusted, it would be carry forwarded, and on carry forwarding also, it would be adjusted only with speculation income. And here the time limit for carrying forwarding is just 4 years. You do not have the time limit of 8 years. Here the time limit for carry forward is just 4 years. What is speculative business, which we already discussed? In case you need a reference, this is given in the blue box here. Next is 73A, specified business. Loss from specified business can be adjusted only with the profit of specified business in same year also, and on carry forwarded also it can be adjusted only with specified business income. Again, here interesting is people tend to remember the number of days, number of years as 4 years. This loss can be carry forwarded for indefinite period, because what is the point if of giving capital expenditure as deduction when you are limiting the loss, limiting the adjustment of losses only to 8 years. So they give you indefinite period to adjust losses. So first 10-15 years the company does not even have business income because they have so much losses to set it off. Next is loss from activity of owning and maintaining racehorses. I told you other loss, interest, dividend may you will not generally have so much of losses. Casual income may you cannot have loss, and you cannot adjust loss of any income from such casual incomes. Remaining is your owning and maintaining racehorses, which is my section 74A, which talks about loss will happen only when your expenditure for maintaining the horse is more than the stake money, and such loss can be adjusted and carry forwarded and adjusted only for a period of 4 years, and that too with the income of owning and maintaining racehorses only. See, just pay you have intra-head restriction, inter-head restriction will also prevail, and carry forward restriction again will also prevail. So can I say 4 years is for racehorses and 4 years is for speculative business. Specified business, indefinite period. House property, 8 years. PGBP, 8 years. Salary mein there is never a loss. Last head is capital gains. Section 74. Capital gains may, again, just for the remembering purpose, long-term capital loss only with long-term capital gain, short-term capital loss with both short-term and long-term capital gain. Other losses can be adjusted with capital gains, but capital losses cannot be adjusted with any income. Now, on carry forward, such losses will be adjusted only and only with capital gain income. Again, long-term capital loss carry forwarded would only be adjusted with long-term capital gain income. Short-term capital loss carry forwarded can be adjusted with any capital gain income. The time period for adjustment here is also 8 years, immediately succeeding the year in which the loss is incurred. Sorry. So that's all about adjustment of loss. If I come to order of losses, first you have to make current year losses, then you have to make the adjustments of carry forward losses. When I talk about your unabsorbed depreciation, unabsorbed scientific research expenditure, unabsorbed capital expenditure on family planning, the list goes like, first you will adjust brought forward business loss. Why? Because this has a time period with it of 8 years. Then you will adjust unabsorbed depreciation, and then you will adjust unabsorbed capital expenditure on scientific research, and then you will adjust unabsorbed capital expenditure on family planning. Any doubts? This is not a thank you part. Abhi we have lots of technical questions. So on this note, let's do one question. Achha, students, many times students ask 112A, may capital gain is taxable up to the extent over and above the limit of 1 lakh. Loss is also adjustable. It's no more a capital exempt income. So loss of listed shares, equity oriented funds, a loss on transfer of shares, equity oriented funds, or your unit of business trust can also be set off with which SCT paid long-term loss can be set off with long-term capital gain income, and there is no 1 lakh which you have to adjust. 1 lakh is for the taxability purpose. Okay, capital gain pura tax hota hai. On the screen, everyone. Please see the question from Mr. Vikas. Mr. Vikas, a resident individual, furnishes the following particulars for previous year 2021. Income from salary computed 50,000, house property loss 24,000, non-speculative business 24,000, Speculative business loss 6,000, short-term capital loss 25,000, long-term capital gains 21,000. This is a loss, and why didn't they put it in bracket? I don't know. So what is the taxable income? Quick. Abhi, chapter is not over. You are not inter-level students. There are now some technical aspects for amalgamation, demerger, reorganization, and shareholding provisions, change in shareholding. Now, all of that is theoretical. So I would request anyone has any doubt or needs to repeat any topic can give me a query on that. Okay. So now we begin to the other part. Now some technical part. Okay. Yeah. Section 72 set of carry forward of business loss. Now section 72 ka there is a proviso for rehabilitation of business. Where if there is a loss which is sustained in a business which is discontinued in the circumstances mentioned under section 33B. Now 33B you must have seen at a lot of places. Now 33B talks about both of it's like 3BB. Such a bad right? 33B talks about circumstances where a business is revived or reconstructed or re-established once it was destroyed because of earthquake, typhoon, attack of enemy, war, civil disturbance. So just say your business got shut down and now you have revived it, re-established it or reconstructed it. That is called revival of business. Okay? So if in case of revival of business, which has been revived within 3 years of its shutdown, within 3 years from the end of the previous year when it was discontinued, the loss which is attributable to such business would be allowed to be set off against the profit and gains of such business for a fresh 8 assessment years, which would be the year when it is revived plus next 7 assessment years. Okay, so this is what my proviso to section 72 says. Next is now business loss. I only told you that only the assessee who incurs such loss can adjust it. Exception is inheritance by succession by inheritance. But what about amalgamation, demergers, reorganization? Usme whether the assessee will get it or not, whether the amalgamated company will get it or not, or whether the resultant company will get it or not, let's understand those provisions. Now, usme na there are 3 provision students which happens. One is the provision of section 72A, which is amalgamation of certain entities, demerger and reorganization. इसमें amalgamation है of certain undertakings. So don't get confused. Demerger and reorganization, which is covered in your section 47. Okay. Then there is 72A, which talks about amalgamation of banking companies. Now, earlier this was banking company with banking institutions. Now they have, because of so many bank amalgamations happening recently in April, so many banks, government banks are amalgamated. Keeping in view all of this, it covers the amalgamation of banking companies, new bank, then your insurance government companies, all of this is covered here. And then there is 72AB, which talks about your reorganization of cooperative banks. So important is to see which section to apply. Now, first, I'll teach you demerger and reorganization, and then I'll come to amalgamation. So first, let's take an understanding of my section 72A for demerger. Now, they say, very simple concept, but if you read the theory, you will write what is written. Demerger के केस में suppose this was the company A and B. Now B has been demerged and now B is a independent company. Okay. Now demerger के case में what this section says, this section says that the loss which is directly attributable to the company which has been demerged, to the company which has been demerged. So now if we know that this is the loss of unit B or loss of part undertaken by B company, that would be allowed to be set off by B company for the unexpired period. So suppose there was a loss which was completely attributable to B unit of company AB of 4 lakhs, which has been already carried forwarded for 3 assessment years. Now this loss for the remaining 5 assessment year, beginning from the assessment year, in which the demerger has happened, would be set off by B company, And when I say loss, business losses, I do not include my speculative business loss. Speculative business loss is not allowed for the new entity, whether in case of amalgamation or demerger or reorganization. Okay? Only business loss and unabsorbed depreciation, which we are talking about. Again, I'll repeat, loss which is directly related to B company would be carry forwarded by B company, and the loss which you cannot directly relate, would be proportionated and allowed to B company for the unexpired period. Now, proportionated means suppose company AB ka total loss was 100 crores, which was not directly related to AB, but AB ka total assets were 400 crore and B ko asset which were transferred was 100 crores. Now, how much of the unrelated, or not 100, let's make it 150 crores. Now, how much of the unrelated loss would be allowed to be, unattributable loss would be allowed to be carried forwarded by B company? Simple unitary method, guys. 100 crore ka loss hai, B has got only 150 crore assets out of the total 400 crore assets. 37.5 crore would be allowed to be carry forwarded to B for the unexpired period. So this would be allowed in the same proportion in the value of asset retained by the demerged company and have been transferred to the resulting company. Simple unitary method. Is it clear for demerger? And whatever central government makes any rules or any notifications or any conditions in relation to this, that would apply. But the demerger should be the one which is for genuine purpose. Yes, Srinivasa, you can say then the income of that land would be clubbed in the hands of the parents. Same treatment will go, absolutely same treatment. And for the illustration, which I did not share the answer was 26,000. This was tend to be your homework. So the answer was 26. Sorry. Uh, Sumit say that the assets are not transferred to demerged companies. That would not be the scenario because obviously a company has demerged. It will take something which is there in its name. And if no asset has been transferred, then obviously no loss which is unattributable completely would be allowed to them. ट्रांसफर पड़ा था ना डीमर्जर का फॉर सेक्शन 47 कॉस्ट ऑफ एक्विजिशन फॉर demerged company, cost of acquisition for the shareholders of demerged company पड़ा था. So this is one such provision of the set off. Clear? Now we come to business reorganization. Students, business reorganization, when I say business reorganization, can I just divide it into two categories? One is firm into company. Sorry. Another is your sole proprietary into company, which you have studied in your section 47, 9, 13. Do you guys relate? I hope so, yes. Okay. And section 47, 14, 13, sorry. Huh. इसमें obviously there are the condition of holding assets and liabilities. So in the case, please listen carefully now. When a firm is getting converted into company, or when a sole proprietor is getting converted into company, or when an unlisted company is getting converted into an LLP, the successor will get fresh 8 assessment years to carry forward the losses incurred by the predecessor if they fulfill the conditions which are mentioned in these sections. Only if they fulfill the conditions which are mentioned in these sections. Again, I'll say accumulated losses would be allowed, which would be your losses of the predecessor excluding speculative business. Okay? And if in the year in which you do not follow the conditions, one would happen is the transfer would be treated as taxable. Long-term capital gains or capital gain would be taxable. Second thing which would happen is that any set off of losses which you have taken, which you have adjusted with your income of the predecessor would now be treated as your income, and the losses which are still remaining to be set off and are to be carried forwarded would be lapsed. Again, I'll repeat, if you will not follow the conditions which are given in these sections, one would happen is withdrawal would happen as per section 47A, capital gain would happen. That is not the chapter which you are doing. But another is whatever set off of losses which have treated from your income would become income of the year in which the violation happens. Second, the losses which are yet to be carry forwarded would lapse. Okay? Clear? So this is what happens in case of reorganization. Any doubt? Now we come to the last part, which is my amalgamation one, which I specifically not like it though, but it is interesting. Amalgamation. So again to repeat, demerger के केस में simple resultant company will take full right over the loss which was attributable to it, which was not directly attributable to it proportionately. Reorganization के case में successor will get fresh assessment 8 assessment years, but they have to follow the conditions. If they will not follow the conditions, whatever losses has been claimed out of the income would be now be treated as deemed income, and the other losses will lapse. Now we come to amalgamation. Section 72A में amalgamation. Okay, so when we talk about amalgamation, the amalgamated company would be allowed accumulated losses of the amalgamating company if certain conditions are fulfilled. First of all, when we're talking about amalgamation, we not talk about all amalgamation. We talk about amalgamation of industrial undertakings. What are industrial undertakings? Industrial undertakings who are into manufacturing of goods, into computer software, into your power distribution generation, into your telecommunication services, into mining, into construction of ships, aircraft, rail systems. These are my industrial undertaking. So amalgamation only of industrial undertakings, amalgamation of a company which is into ship business or hotel business, or which is into operation of airlines, or amalgamation of a banking company with a specified bank. When I say specified bank, with the subsidiary of SBI. Only these amalgamations are covered here. No other amalgamation is covered here. An amalgamation between X entity which is not into any business, which is not an industrial undertaking, with a Y entity. So the losses of X entity would not be allowed in that case, because it's not an amalgamation which is allowed as per section 72A. Okay, number one. So only the amalgamations of industrial undertaking, ship, hotel, amalgamation between the aircraft business entities who are into operation of aircrafts, amalgamation between a banking company with a specified bank, and specified bank means SBI, ka subsidiary. Only these amalgamation. Number one. Number two, certain conditions have to be fulfilled by amalgamating company and amalgamated company for carry forward of losses by amalgamated company. Condition which has to be fulfilled by amalgamating company is first that the losses which are unabsorbed and will be allowed to the amalgamated company should belong to a business which is run for at least 3 or more years before the date of amalgamation. So that means a new business loss of an amalgamating company would not be allowed to be carry forwarded to amalgamated company. So at least a 3 or a more year business loss should be there. Also, at least three-fourth of the book value of fixed assets should be held by the amalgamating company. At least three-fourths of the book value of the fixed assets on the date of amalgamation should be held by the amalgamation company for at least 2 years prior to the date of amalgamation. So can I say at least 75% of the book value should be same of the asset on the date of amalgamation and 2 years prior to it. This is the condition first to be carried forward, and these conditions are to be fulfilled by amalgamating company. Now moving to the amalgamated company. The business amalgamated company should continue the business of the amalgamating company for at least 5 years. The business should be continued for at least 5 years. 3/4 of the book value of the fixed assets of the amalgamating company should be acquired and should be kept for a minimum period of 5 years, effective from the date of amalgamation. I'll repeat each one thing same. And then further condition, which is given by rule 9C. Now this is thoda sa funny. They have to reach at least 50% of the installed capacity by the end of the 4th year of amalgamation and should maintain the same by the end of the 5 years. So 50% of the installed capacity should be operational by the end of the 4 years from the date of amalgamation, and the same should be maintained for at least 5 years. And all of this should be verified by chartered accountant in form 62. What is this? Okay. Amalgamation के case में set off and carry forward of losses by the new entity, which is your successor entity, is not that easy. You have to take care of few things. First, why they have done so? Number one, because they want to, because fresh 8 assessment years are allowed to the amalgamated company to carry forward such loss. So the income tax authorities want to ensure that such amalgamation is genuine, the business activities are same, the book value of fixed assets are tend to be same. So they want to ensure this. So for set off and carry forwarded, they have put certain restrictions. First of all, the loss should belong to a business which is being carried by the amalgamating company for the 3 years, and the book value, at least 75% of the same should be same for at least 2 years prior to the date of amalgamation and on the date of amalgamation. Okay? Now, the new company, the amalgamated company, to claim the carry forward and set off of such losses, should for at least 5 years run the same business, which is of the amalgamating company, should for a minimum period of 5 years hold at least 3/4 of the book value of fixed assets of the amalgamating company. Okay? Then obviously its intent is to run business. So at least whatever is the installed capacity, by the end of the 4th year, they should reach 50% of it. And by the end of the 5th year, they have to maintain it. ऐसा ना हो that you have reached 50% of the capacity, but you have not maintained it till the 5th year. Okay? So basically, you can see for the amalgamated company, all the conditions are there for 5 years to follow. And then obviously a CA has to certify that all these conditions have been maintained. Now, once these conditions are met, the successor company will get the loss of the predecessor company to carry forward and set off. If the conditions are not met, same. Whatever the loss has been allowed to be set off would become the income, and the remaining loss shall lapse. Clear? Take a time to understand it, and any doubt you have, you can give a query on it. Ma'am, do we have to remember the condition? Yes, you have to. Okay, few questions. Since we are attributing loss to the demerged entity in the ratio of assets, what if the loss is only related to a particular asset pertaining to only demerged entity? See, first of all, this is again a very typical condition. When we talk about accumulated losses, students, we tend to talk about your business losses. We tend to talk about your business losses. not any other head losses, and again not speculative losses and business losses and your unabsorbed depreciation, because we have to see the genuinity of business, right? So again, when we talk about business losses, these cannot pertain to a particular asset, and I'm talking about accumulated losses in all these three scenarios, which are your PGBP loss, not your speculative loss. Clear? Will you be able to remember these conditions? Next question is, Ramaya, I did not understand if deemed income or loss arise subsequent to demerger, can the resulting company claim it? I did not understand this. See, deemed income I'm saying is the loss which you have claimed and you have not followed the conditions. If you're not following the condition, the losses which you claim will become the income. So if suppose I'm an amalgamated company, I carry forward and set off the losses up to the extent of 100 crores. But in the fourth year, I'm not fulfilling the condition of capacity. So 100 crores of losses which I've set off of the amalgamating company would now be my income in the year when I not follow the condition. Installed capacity basically means the capacity of production on date of amalgamation. So if amalgamation ke time pe the factory has been set off. See again, amalgamation are the one only of industrial undertakings and the ones which are there in the businesses, right? So if on the date of amalgamation, there is a capacity of the amalgamated company to produce 100 lakhs of, or say to produce 100 lakhs of a product. So at least 50%, at least by the end of 4 years, they should produce 50 lakhs of that product. So this is your installed capacity. Good, keep coming more questions, students, because this is a typical one. Any other doubt? If you will understand section 72A, trust me, 72AA and 72AB are just 5 minutes thing. Clear? Okay. Deemed income under section 45. Under section 45. Deemed income under section 45 arised after demerger. While will the resulting company be liable for that income if it arises after demerger? I think, Ramya, you're confusing it. We here are discussing with the losses which happen to be of these entities. in case of amalgamation of this entity, in case of reorganization of either firms, sole proprietor or company which are predecessor, in case of demerger of company A, B, because they were in existence. Okay, now either demerger happened and B company is now separated, or reorganization happens and when we have a new company or a new LLP as successor, or in case of amalgamation as the amalgamated company as successor. So we are talking about the cases under section 72A where, remember 72 may we studied only the person who incurs the loss would be allowed the loss. But here in this case, the predecessor and successor are different, but they are allowed to be carry forward the loss of the predecessor, which are marked in yellow, which would be allowed only if they follow certain conditions, which would be allowed to be carry forwarded and set off only if they follow certain conditions. So in this deemed income, I do not think would come into picture. But what income part I'm saying is that if they are allowed to be carry forward certain loss and they do not follow certain conditions after carry forwarding that loss, so that loss which you claim as income would be treated as which you claimed from your income would be now treated as your income. So this is what we are talking about. Other than that, deemed income does not come. I think section 45 does not has any deemed income. So you are seeing deemed income under section 41(5). Deemed income under section 41(5), which you are saying for the profit chargeable to business, you want to set off with these losses. See, once I got your point now. Suppose recovery of bad debts recovery happens, and now you're saying this loss can be set off. Yes, this can be set off with if suppose B unit car recovery of bad debts happen, then that can be set off with the loss of that. I think you are asking about that. That can happen. Clear? Okay, so next is your carry forward of and setup of accumulated business losses and unabsorbed depreciation in scheme of amalgamation in certain cases. First of all, section 72AB talks only about amalgamation where predecessor amalgamated companies ka loss would be allowed to be set off by the successor amalgamated companies. Okay, these first, this section was before your Finance Act 2020 was only applicable to banking companies, banking company getting merged or getting amalgamated with other banking companies. Now they have intent to include certain companies, not only banking company with banking institutions, new banks with any other new corresponding bank, your government companies who are into insurance business with any other government company who are into insurance business are covered here. So the accumulated loss of the or the unabsorbed depreciation of the amalgamating company would be considered to be the accumulated loss and unabsorbed depreciation of the amalgamated company as per section 72AB. No such hard and force condition. Just remember, when I say accumulated loss under section 72, 72A, 72AA and 72AB, I mean PGBP loss and not speculation loss. Clear? Now 72AB talks about reorganization of your cooperative bank. Now, reorganization can be of demerge in the form of demerger, can be in the form of amalgamation of cooperative banks. Same things apply in case of amalgamation. And in case of demerger, same thing which we did in your section 72A, totally same thing apply for section 72AB, but in the sense of your cooperative bank. Section 72AB. This is reorganization of cooperative bank. इसमें one is amalgamation, another is demerger. ठीक है, demerger के केस में obviously you have to take care the directly attributable loss of a cooperative bank of the resultant cooperative bank would be allowed to the resultant cooperative bank for the unexpired period, and the one which is not directly attributable would be proportionated on the basis of capital fixed book value of the fixed assets. ठीक है, amalgamation के केस में the amalgamated cooperative bank, which is a successor cooperative bank, would get or would be allowed carry forward in set of losses of the amalgamating cooperative bank, which is your predecessor bank, if the conditions are fulfilled. The conditions are same. This cooperative bank should be engaged in the business of banking for 3 or more years before the amalgamation. At least 75% of the assets should be same on the date of amalgamation and 2 years prior. Same, they should run the same business for a minimum period of 5 years, the resultant cooperative bank. Same as amalgamation, which we did in 72A. And at least 3/4 of the assets should be there for the amalgamating cooperative bank, and the same should be carried for a minimum period of 5 years. Clear? And any other condition which the government says, but it should be a genuine purpose amalgamation. Clear? Any doubt? In case of reorganization of cooperative banks, student, 2 previous year happens in the same previous year. One previous year would consider so suppose a reorganization happens on 2nd August. So 1st April to 2nd August would be one previous year, and then 1st April to 1st August would be one previous year, and from 2nd August to 31st March would be considered as another previous year for all purpose, for the reorganization of bank, cooperative banks. Clear? So if you understand 72A, students, 72AA and 72AB are clearly off and on the same lines. Please, still you have any doubt, you can still ask. Last 3 small and important provisions. Section 78 talks about change in constitution of firm or succession. Succession is succession of business. Again, no succession, no successor is allowed carry forward the losses of a business of a predecessor until and unless that succession is by inheritance. And in case of constitution of firm, what is mean by constitution of firm? That some person is retiring or some person died. So because of that, if there's any change in the pattern of the partnership firm happens. So suppose A, B, C are 3 partners. C retired. So whatever share of losses was attributable to C would lapse. That would not be allowed to be carry forwarded. So if the total losses allowed to be carry forwarded were of 90 crores, So seek apart, and everyone was in the share of 1:1:1. Seek apart, now since he retired, 1/3 would not be allowed to be carried forward. So only 60 crores will now be carried forwarded from the date and set off from the year of constitution. But this does not apply to unabsorbed depreciation. This only applies to your losses, but not on unabsorbed depreciation. Unabsorbed depreciation, full ka full would be allowed to be carry forwarded. Is it clear? And succession, I told you, succession by inheritance is allowed. Now suppose Mr. A had two legal hire, uh, his son B and his son C. Okay. Now, Mr. A is running a business. I told you succession by inheritance is allowed. So this successor would be allowed to carry forward the loss of predecessor. Correct? If they're running the same business. But suppose son B and C make a partnership firm after the business of Mr. A with Messrs. B and C. Son B and C made a partnership firm. Now, the question comes whether this partnership firm would be allowed to be carry forward the losses of the proprietorship firm of Mr. A. The answer is yes. They are allowed to be carry forwarded. Now, it is on them whether they follow as a separate business or whether they run into a common name, but the business should be the same. Clear? Next, and the most important section is your section 79. Now, section 79 talks about carry forward and setup of losses in case of change in substantial holding. Now, first of all, this section is only applicable to closely held company in which public are not substantially interested, or your private companies. Okay. Now, private companies may, to encourage a genuine patent holding, they say, please listen carefully, they say that the carry forward and set off of accumulated business losses is not allowed in case common shareholding of 51%, in case common shareholding of 51% is not maintained on the last date of the year, current previous year, and the last day of the year in which such losses incurred. What did I say? So they say at least 51% of the holding should remain the same in the year of loss and in the year of set off. In the year of loss and in the year of set off, to carry forward and set off the same. So suppose X and Y are two shareholders, 50%, 50%. Okay, year of loss है, then again year of loss पे Z partner, Z company, Z shareholder came in and X transferred his share to him. Now, in the year of profit, when you actually have to set off, X again has 50% holding and Y again has 50% holding. So you have to see the year of loss and the year of set off. उन दोनों के बीच में the shareholding should not have changed more than 49%, or at least 51% or more should be the same. In between it got changed, then it got resettled to back, that is immaterial. You just have to pick up the year of loss which you want to set off after getting carry forward and the year in which you are setting off. If it is not the same, the loss would not be allowed to be set off. And when I say these should be beneficially held by the person, beneficial owner should be seen. Another thing, if exception, if the shareholder dies or the death of the shareholder happens or the shareholder gift such shares, then this restriction would not be considered. So example, suppose XY in year of loss were two shareholders holding 50% each. Okay. Now in year of profit, what happened? And you have to compare on the last date of the year, not at the beginning also. In the year of profit, what happens before the year could end? X dies and his share were now, as because of his death, were given to his son, Mr. Z. Mr. Z. Now you will see whether Mr. Now since prima facie you will see the shareholding has changed. More than 49%, 51% is not the same because earlier X had 50%, now Mr. Z has 50%. But this happened why? Because of the death of Mr. X. So in this case, set off of losses would be allowed. In this case, set off of losses would be allowed. But if Mr. Z would have been some XYZ person and X is very much alive, then it would not be allowed. So to read the exact technicality now, which you will understand. In the case of a company in which public are not substantially interested and not being an eligible startup, referred to in ATIC, no loss incurred in any year prior to the previous year shall be carried forwarded and set off against the income of the previous year unless on the last day of the previous year, the shares of the company carrying not less than 51% of the voting power were beneficially held by the persons who beneficially held the shares of the company carrying not less than 51% of the voting power on the last date of the year or years in which such losses incurred. See, student, this restriction is only for your private companies, not for your public companies, because public companies may every day basis where shareholding changes. This is only that not very often the shareholding change for your private companies. So that's why shareholding details are also now considered for your setting off and carry forward of losses. But suppose now interestingly, if you are a company in which public are not substantially interested, you are a closely held company, but together you are a closely held company, but also you are an eligible startup. That means you're an eligible startup and a closely held company. Eligible startup are the startups which are allowed a deduction of tax holiday under section 80 IAC, and those who have a certificate from the Ministry of Wood, and those who are into eligible business of basically innovation and innovation of products, services, and basically having a potential of it. This which you will do in your ATIAC or AMSE. So if you are an eligible startup and a closely held company, then for the first 7 years, basically, which is your tax holiday period, eligible for tax holiday period, for the first 7 years, to set off the loss, the condition is that in the year of loss and in the year of set off, in the year of loss and in the year of set off, here the condition is at least 51%. Here the condition is that all the shareholders should remain the same. Not technically for the first 7 years, I should say it correctly, like the losses which pertains to the first 7 years, the losses which pertains to the first 7 years can only be set off if in the year of loss and in the year of set off, all the shareholders are same. Again, I'll repeat, not for the first 7 years, but the losses which have been incurred initially for the first 7 years, then whatever the losses belong to these 7 years, beginning from the incorporation year, these losses can only be set off if in the year of incurrence of loss and in the year of set off, all the shareholders are same. Now, if losses are for the 8th year from incorporation, or if the losses are the one which are incurred after 7 years, uske liye the same condition this would apply, that at least 51% shareholding should be the same between the year of loss incurred and the year of set off. But if the losses are belonging to the first 7 years, then when they are set off on that date and on the incurrence, all the shareholders should be the same. So this is a typical condition for 80 IAC eligible startup. Again, this is to encourage these startups to have a concrete holding and ownership pattern, and it should not be a startup just to claim the benefit of tax holiday, but it should have a ongoing vision so that the shareholders are not changing. Clear? Any doubt up till now? For amalgamating company, yes, you get fresh years. For the resultant company, you get the unexpired period. Clear? Amalgamation, demerger, organization, cooperative banks, succession, constitution of firm, closely held company के case में year of loss and year of set off में at least 51% holding should be same. And 80 IAC में for the first 7-year losses, or the losses which belong to the first 7 years of incorporation, can be only set off when in the year of set off and in the year of loss, the shareholders remain the same. 100% holding should be the same. All these conditions of section 79 would obviously not be applicable if the shareholding changes because of the death of a shareholder or because of shares given as gift. If we are talking about a subsidiary Indian company of a foreign company, which is an Indian company of a holding foreign company, then if obviously the foreign company holding changes because of amalgamation demerger, subsidiary company holding also changes, but that will not apply to them. If the change in shareholding has happened because of a resolution as per the IBC, Insolvency and Bankruptcy Code, if the change in shareholding happens either to the company or to its subsidiary because of the tribunal, the NCLT has ordered change in management on receiving the application of mismanagement, then in that case, when other independent person takeovers, so all these conditions would not be the restriction of change in shareholding. So the change in shareholding happens because of these 4 conditions, then even if the change is more than 51%, then also the set off would be allowed. Any doubt? So to the last section, and a very common and a very important section. Section 80 says, that to carry forward such losses, to carry forward and set off such losses, you need to file your return under the head loss return, which is my 139.3. You need to file your return, and you need to file your return timely. It should not be a belated return. It should not be a late return. So you have to file your return within the due dates, and then only you would be allowed to be carry forward the losses. But the exception are unabsorbed depreciation and house property losses can even be carry forwarded even if the return is not filed within the due date. But other losses, namely business loss, speculative business loss, specified business loss, capital gains, owning and maintaining resources loss, all would be allowed to be carry forwarded only and only if the return is filed within the timeline. And this is the condition for carry forwarding of loss. Intra head adjustment के लिए I can file the belated return, but carry forward नहीं होगा. Okay. So intra-head adjustments के लिए I can file the belated return, but for carry forwarding the losses to the next year, I have to file the return within the time period. So with this, our two good chapters are done. If you will listen to this lecture and if you will read this chapter, I think chapter reading would hardly take you 1.5 hours, and I think it would be good to go for the exam purpose. And now exam se pehle, you can hardly pick it up for half an hour and you would definitely know all these concepts. So any doubt? So now we'll be hopefully be meeting after the new year. I just wish you all people good luck. Study, study, study. Please don't change your focus. I know the world is going through a really dark stage, but please study and focus on all good things and just prepare, write, study, practice. Okay, so I hope today's class, you enjoyed today's class and learned some new things. Thank you very much. See you in the next class. Thanks a lot. Happy New Year.